Good evening. I am Dr. Ramrup K. Sharma. Today, I would like to share my knowledge on audit. Audit is an examination of books of accounts, records, vouchers in order to ensure whether books of accounts and financial statements exhibit true and fair view of state of business with respect to profitability, that is, whether profit or loss of the business, and with respect to financial position, that is, position statement, that is, balance sheet, position of assets and liabilities. Basically, I am discussing today financial audit, that is, audit of financial statements. Financial statement has been defined by Companies Act 2013. Financial statement means profit and loss, balance sheet, cash flow statement, notes to accounts and accounting policies, and other comprehensive income. Because financial statements are more important for the business, as business is for business, means business is generally for the profit making. So profit is a key to survival. So businesses need to make progress, and such progress is captured through financial statements, whether financial statements made by companies are true or not. For that, audit is necessary. Audit is compulsory for most of companies. Therefore, concept of audit is there. Audit starts after accounting is over. So audit is basically an examination of financial statements to ensure whether such financial statements exhibit true and fair view with respect to profitability and position of a particular business, generally companies. So true and fair view concept is fundamental and crux for the purpose of auditing. If we consider certain points here, then auditor has to see to support the fundamental concept of true and fair for the purpose of carrying out auditing. The auditor must see that this opinion is based on true examination of such financial statements. So in order to ensure true and fair view, an auditor will consider that assets have been properly valued. Assets should not have been undervalued or should not have been overvalued. They should have been valued based on accounting principles, accounting standards, accounting rules. For example, a property, plant and equipment AS10 is there and equivalent Ind AS is there. So valuation model must have been followed, keeping in mind as per the requirement of accounting standard and not as per wishes and whims of management, and there should not be earnings management. So auditor has to be careful with respect to that proper valuation of assets and liabilities, particularly assets, because assets generate revenue for the business. So proper valuation has to be there based on accounting standards. Second point, recording of assets should be there. That means no material or major assets are to be omitted. They should be there in the balance sheet. They should not be off the balance sheet, because assets are resources producing revenue. Therefore, such resources must be there in the balance sheet statement. They must be recorded. There should not be any omission. They cannot be excluded. They are important for the purpose of business survival, for the purpose of operating activities of business, because they support the revenue generation activity, and revenue generation will give the profit. And as I earlier said, business is for business. So generally objective of business is a profit. Therefore, if assets are productive, they are recorded, they are properly valued, the financial statement will be showing true and fair view. They will be updated, and if there is no proper valuation, balance sheet will be outdated, though balance sheet will be prepared. So there should not be any omission of assets in the balance sheet. Third point, if assets are charged, means if there is any charge on assets mortgaged, charge can be fixed charge or floating charge. For example, if company wants to take loan of 5 crore, bank will ask what is security that you are going to repay it. So company may mortgage certain assets. If a particular asset is mortgaged, we call it a fixed charge, example plant and machinery. And if there is a floating charge, that means charge on all assets. So bank will have the right on all assets in case of default and to recover the loan amount. In case of fixed charge, only particular asset right title is transferred to the bank for the time being for the purpose of timely repayment of loan with interest. So charge, if any, there should be disclosed. Say below the balance sheet we are making notes to accounts, and there in the assets where we are writing, proper disclosure has to be there that so and so asset has been mortgaged against the loan of 5 crore with so and so bank. Next point, material liability should not be omitted. The concept of materiality is there. If small amount, the business may not have widespread effect. Materiality means ability to influence the decision making. So the size, materiality in simple words means the size. When we talk of the size, I can give one example. Though there is no fixed formula for materiality, say balance sheet total side is 50 lakhs and 10% of that is 5 lakhs, so up to 5 lakhs or more than 5 lakhs value of asset will be more important for the business. So this is like materiality. And below 5 lakhs, an asset of 50,000 may not be that important for the business. So therefore here the focus is not on the small things, but the materiality. So that is based on judgment of auditor. He will decide as per conditions, risk of the business, his knowledge, and the kind of goods dealt in, the kind of scenario like it is COVID. So in case of COVID, what is a kind of risk, business risk and different risk. So considering that, he will decide materiality. So they should not be omitted. Material liabilities and assets should not be omitted, means they should not be omission, means material assets and liabilities must be recorded in the balance sheet by the business. For I can correlate one case study with respect to material liabilities of the balance sheet item. For example, Enron fraud occurred around 2000 in the US. Enron company, it was energy, it was dealing into electricity business, it was among top companies. So what the company did is the recorded liabilities outside balance sheet in the notes of balance sheet item, and then there was lot of, like, company was not in a good condition already, and then they had lots of borrowings of balance sheet item they disclosed. They omitted liability from the balance sheet, and the interest kept on mounting, also repayments kept on mounting, and it was exposed, and then it went to bankruptcy. So it is going to kill the organization in the long term. So therefore such malpractices lead to fraud. So auditor has to be careful. Next point, profit and loss and balance sheet must follow the all disclosure requirements as per the law, say Companies Act 2013, Schedule 3 Part 1, Part 2, and other requirements of accounting standard which promote disclosure, and rules of accounting from time to time, gazettes and circulars, and this is a minimum mandatory. Over and above these, companies can always follow voluntary disclosure requirements, so that is up to them, but minimum disclosure requirements, because convention of full disclosure is there in concepts and convention. And full disclosure means company cannot hide, cannot partly disclose the transactions or information, otherwise that is going to influence the decision making of stakeholders, and that is not good. Sometimes some research also supports that enhance disclosure, more disclosure, maybe for good companies may be practicing, and their share prices will be little higher. Their shares will be traded at premium if their disclosure practices are very good. That kind of research already is there, it supports, right? So positively, more disclosure is positively related with the capital appreciation. Next point, accounting policies must be followed consistently. Consistency concept is there in accounting. Consistency means account same uniform throughout. Don't change policies every year. Keep them uniform to the extent possible. What is accounting policy? Means accounting method. For example, how to value the inventory based on what is the policy. Book value or market value, whichever is lower, that kind of valuation you are doing. LIFO, FIFO, which method you are following. So what is your policy? If policy is say LIFO method, then follow it uniform over the years. Don't change it as per whims and wishes of management, otherwise it leads to earnings management. Change it only when required. For example, law requires to change, then change it. Another example, accounting standards require to change it, then change it. Then such a change will lead to better presentation of financial statements, then also you can change it. Otherwise don't change. So there should be valid reasons of change, then we can change, otherwise not, generally not. And last point, all abnormal transactions, non-recurring transactions, extraordinary transactions should not be mixed with the operating transaction, should not be mixed with the financial items related to operating. For example, extra loss due to earthquake is not a normal activity, is extraordinary, not non-recurring, should be shown separately. Another example, capital gain on sale of fixed asset is not operating activity, so we cannot add or we cannot mix this gain with the uh, gain on sale of goods, because both are separate thing. Gain on sale of goods is a normal activity, operating activity, and we hardly sell fixed assets in the business, rather we maintain them, we buy them, right? That therefore it is non-recurring item. Sale of fixed asset, gain on sale of a fixed asset is a non-recurring item, and it should be shown separately in profit and loss. I hope you enjoyed it, the lecture. Thank you.